Traditionally, people focused on oil prices. Right now, what we're seeing is oil steadying, but we're seeing the rest of the commodity complex surging ahead, up some 8.2% since the end of February. What makes for the divergence?
Copper is the new oil. We put out a piece back in 2021, making these bullish arguments. And by the way, they haven't worked out. But I talked to a lot of people who will say copper is their highest conviction trade. I wear my copper bracelet right here. It is the highest conviction trade I've ever seen. If you've got decarbonization, green CapEx demand, AI, data center demand, military demand, it takes 12, sometimes 26 years to bring on new supply. You can't come up with a better story. But the bottom line, we've been telling this story for 3 years, and maybe now it's beginning to work. I'm confident that this time it's liftoff, and I think we're going to see more momentum behind it because you have three sources of demand this time around, meaning green CapEx, AI, plus military. Back in 2021, all we had was the green CapEx demand, and now it's in full force. Supply's not there, inventories are tight.
Prices have more than doubled going back to March of 2020, and I'm looking right now. How far more is there to rally at a time where you're still wearing your copper bracelet?
I think our target was $15,000 a ton when it's trading just a little bit above 10,000 as of this morning, which means it's got a long ways to go. Where do we come up with that 15,000? It was the highest real price ever reached in 1968 during that housing boom. So we don't know where demand destruction occurs. All we do know is that bringing on new supply is very difficult. So we're going to learn where those price levels are, where you begin to kick out demand. But I go back to the 2000s, and as bullish on oil then as I am copper today. Oil ended up going up from 20 to 147 times. So, the upside on copper here, I think, is very significant.
We're seeing a lot of supply when it comes to countries outside of OPEC plus, Jeff. Do you think that potentially we're on a bearish trajectory when it comes to the oil market for this year and next?
Absolutely not. One of the big sources of oil supply over the last 18 months came from sanctioned countries. Venezuela, Iran, Russia. Yes, they've attacked these sanctions and clamped down, but they don't come into effect until after the election 180 days from now. So that's been one of the big drivers. And also in energy, don't forget the massive surge in coal production that occurred in China, Indonesia, and India over that same time period. So there's a lot of energy in the system that has backed up that needs to be eaten through. When we think about the underlying demand, it's not spectacular like it is in copper, but it's rock solid. It's well above long-term average growth rates. You're going into the gasoline driving season, jet fuel. And by the way, remember, global warming means your cooling season is going to create more demand in the past. We didn't build inventory, so that 3Q bull story is still very much intact, driven by fundamentals, even without any geopolitical risk priced in. Also on oil, I want to note that when we look at positioning, it's down to the 14th percentile. Now, this market is basically no long positioning in it right now. And we're still sitting at $83, $84 a barrel, which is a testament to the underlying strength. Putting it all together, I want to emphasize commodities are still the best performing asset class despite the pullback in oil prices.
Jeff, let's talk about gold for a moment. I'm not wearing any gold that I can hold up, but it's a time where investors can get real yields in short-term parts of the market. Why are gold prices still going up, and how much of that is activity by the central bankers?
Well, I think a big difference between this commodity rally and any other commodity rally most any human being alive has ever seen before is it's not accompanied with dollar recycling. Meaning, think about, the petrodollar system. Oil prices go up, Saudi Arabia accumulates more dollars, they plow it into U.S. treasuries, puts downward pressure on rates, dollar begins to weaken, which reinforces the reflation, and it becomes a virtuous cycle between oil prices and the dollar, reinforcing higher commodity prices. That's not playing out this time. Why? Because many of the BRICS countries back in November of last year decided to start to trade with one another using local currencies and then settle the differences in gold. So what we've replaced dollar recycling with is gold recycling. And that has created this uptick in gold despite a stronger dollar. Normally, you would look at the fundamentals today and you would go, oh, gold should be going down. Real rates are higher, dollar is stronger. Those are all the dynamics that put downward pressure on gold. Instead, gold's going up. What's driving it is that strong demand coming out of these emerging markets, where they're now recycling into gold as opposed to U.S. Treasuries creating that dollar recycling theme. So this still has more legs to it. You know, we see more upside in gold prices from here.
I guess, Jeff, what we're trying to get at is there are some stories that people have been banding about all year, whether it's the EV transition or some of the grid build out that's going to require more copper usage, whether it's some of the central banks shifting more to gold. Why do they have so much further to go if it's a lot being priced in and speculators coming in and trying to get ahead of them and bidding it up even further? What gives you a sense that there could be a catalyst for another leg higher in the near term?
Because you need to destroy demand. Right now, you're running on fumes of very low inventories, particularly of copper. You have no way to bring on new supply. Once you're out, when prices begin to spike, they got to spike high enough to bring demand back in line with supply. That's where we're going to find out where that elasticity of demand really exists. The only one we can ever observe is going back to the 1960s, which suggests maybe it's 15,000, but we really don't know. We're going to find out. We didn't find out in the 2000s bull market because China was never forced into a situation where it had to consume and you had to ration demand out. That's why we peaked out in that $10,000 a ton range, similar to where we are right now. So going forward, no inventory. Remember, really strong demand from all those sources you talked about. There's not enough to go around. Somebody's going to have to drop out, and that's where we're going to find out where the high print is on this market.
Jeff, if I could just go back to your answer earlier on the oil market, and you see this very bullish market happening, and you see potentially we're not even at peak driving season. If we do see gasoline prices in the United States go past $4 a gallon, are you expecting the U.S. to tap the SPR?
Yeah, but there's a lot of other levers they can pull to put downward pressure on oil prices. That's why I'm far more bullish on base metals, copper, than I am on oil, particularly until you get after the election. Because when you look at what drives elections, what drives the populist focus, it is the economy and inflation. So keeping oil prices and gasoline prices under wraps over the course of the next 6 months, I think is going to be critical to the administration and the government. And we've seen this play out election after election. So I can't see why this one would be any different. What does that limit, on oil? It means you can get up into the high 90s. Maybe, you could top over 100 or something like that in the midst of the cooling season. But, would it be lasting? No, it's not like the underlying copper story, where it doesn't really impact the underlying inflation. Now, you throw in something like some surprise problem in the Middle East or something like that, that could open up the upside. But I think, you're going to see governments around the world doing everything they can to fight this. And one of the ways is, turning a blind eye to, sanctioned oil, sanctioned products. So there's a lot of methods other than tapping the SPR that can be used to, also relaxing environmental regulations. We've seen them use that in the past as well. So there's lots of tools at their disposal.